we have a very limited time to take up all our subjects. And yes, you have a lot of questions that are relevant to the class and our subjects we will be taking up either at the end of the session for the day or at a later date, depending on the time available to us. I find from the questions that many of you have gone far beyond our subject that we are dealing with. So please wait to get your answer. Pay careful attention to the lecture. You will get your answer there. If you do not get it, then you can re-ask the question and we will take it up. Our subject now is motor insurance, liability insurance and PA. Three very wide and very different subjects. The most common is motor insurance. Most of you will be dealing with it or will be hearing of it very frequently. Now, there is a very important law, and that is the Motor Vehicle Act. Under this law, every motor vehicle on the road cannot come on the road without insurance, and insurance to cover third parties. Who is a third party? The third party is the outsider, the pedestrian, the people who are on the road, walking on the road, and whom the vehicle may hit or injure, or whose property may be damaged. So third party is the general public. They are covered for any injuries which may be caused to them by any motor car, two-wheeler, truck, bus, or any other motor vehicle on the road. So this is a compulsory insurance that has to be taken. So if any of you have your two-wheelers or any other vehicle and your insurance is not up to date, remember you could end up paying a large amount of compensation. So please make sure you have insurance as required by the law. The court that decides the amount of compensation to be paid is called the Motor Accident Claims Tribunal, which is MACT for short. So that court decides the amount of compensation. What is the amount of compensation? So we have compensation paid for two different elements. One is called TPPI, that is third party personal injury. So injury to people or death to people in a motor accident, whatever the court awards, that amount has to be paid to the family members or the individual injured. TPPD is third party property damage. The coverage as per the law is 6,000 rupees. So if a truck damages a two-wheeler which is parked on the road, at the side of the road, the property damage claim can be paid for a maximum of 6,000, but the owner of the two-wheeler has to go file a case in the MACT court, and thereafter the court will pay the compensation. So this is according to the law, and for this reason motor third-party insurance is compulsory. So I hope, Vivek, you have heard the answer carefully. It's motor third-party means outsiders, not owner of vehicle, not owner's employees, not owner's family. They are all individuals. They are first parties. The rest are all third parties. So for motor insurance, insurance companies have had divided according to the old tariff. We have three categories, broad categories. One is the private cars, the cars which we use for our personal use. Then we have the two-wheelers, again for personal use. Then we have commercial vehicles. In commercial vehicles, we have the goods carrying vehicles. We have the passenger carrying vehicles, which includes rickshaws, taxis, and buses. We have special trailers. Trailers are registered individually, so we can insure them individually. But they are insured whilst they are stored and whilst they are attached to a motor and towed wherever they have to go. Special vehicles are special category vehicles like ambulances, hearses, our film stars, vanity vans, campers. All these come under special category vehicles. Then we have the motor trade. So motor trade means manufacturers or dealers of motor vehicles being brought from the manufacturer site to the dealer site for sale. That is motor trade road risk. Motor vehicles being sent for demo driving, they come under trade certificate or driver certificate. And the last is motor internal risk, which is the dealer's storage and factory, or the manufacturer's factory and storage locations internal risk. Coverages are very similar, but the only difference is that they have special licenses for the purpose. Motor insurance has two types of policies. One is the package policy or the comprehensive policy, and the other is the liability only policy. As you know, liability only cover is compulsory for all vehicles plying on the road, so this cover has to be taken. In a package policy, it will combine both the liability and the damage to the vehicle. Damage to the vehicle is called own damage. So the motor third party liability only policy covers the requirement of the law, that's the Motor Vehicle Act. In addition, it covers the personal accident to the owner. If it's an individually owned vehicle, the owner traveling in his own vehicle or driving his own vehicle is covered for an accident cover, that is death and permanent total disablements. In addition, personal accident cover, again death and permanent total disablements, may be covered for the passengers also by an add-on, and others like employees or others can also be covered in the vehicle. If it's a bi-fuel vehicle, which we have today, both petrol, diesel and CNG, LPG, then there's an extra charge for that purpose. The package policy or comprehensive policy is a third-party liability coverage, as we have seen just a little earlier, plus the own damage, that is damage to the vehicle by some specified perils. Again, like fire, a specified perils. So what are these specified perils? Fire, self-ignition, lightning, riot, strike, malicious damage, storm, tempest, flood, inundation, terrorism, earthquake, landslide and subsidence, burglary and theft, accidental damage, and transit within India by road, rail or air. In addition, under the package policy, towing charges after a damage to the nearest safe place is also covered for a small amount. Emergency repairs are also permitted for a small amount. In commercial vehicles have additional availability that they can tow a disabled vehicle to a safe place, and if their vehicle is damaged as a result of the towing, their vehicle damage will be payable under the policy. No other private cars or two-wheelers are permitted to tow vehicles. So if they are towing vehicles and the insured vehicle is damaged, insurance companies may not pay the loss. The policy is covering usage within India only in the case of private cars and two-wheelers for social use. In the case of commercial vehicles, the area is India, but again it is restricted depending on the permit that is given. A national permit means anywhere in India. A state permit means restricted to the state. A city permit means restricted to the city usage only. Consequential losses. So after the damage, any other expenses being incurred are not covered because these form under consequential losses. For example, the vehicle is damaged, it is lying in for repairs, so I am incurring extra costs for traveling by taxi for all my appointments. These are not covered. Any other loss of income, not covered. War and nuclear risk, we have seen in fire, it's an exclusion normally. Contractual liabilities are also not covered. A driver under the influence of intoxicants, alcohol or drugs and causing a damage, insurance company will not be liable for the damage to the vehicle. The second important in the policy is called limitation as to use. The vehicle has to be with a valid permit. It cannot be used for racing and other speed trials and speed testing. It cannot carry more than its load in the case of commercial vehicles. The driver who is driving must have a valid driving license at the time of driving the vehicle, otherwise the insurance will not pay for any losses. The premium rates are determined on the zone or area in which the vehicle is plying or it's registered, how old is the vehicle, what is its carrying capacity, that is number of passengers, or its cubic capacity, or its GVW, which is gross vehicle weight, and the value of the vehicle if we are taking for package policy, and that is IDV, insured declared value. It is the sum insured for which the insurance is taken. This is worked out as the new price of the vehicle. If it's a new vehicle, the invoice cost is the value. If it is an old vehicle, the new invoice cost less depreciation for the age of the vehicle. The depreciation is given in the policy. On that basis, a depreciation is applied on the new cost and worked out IDV. So this is the value for insurance. In the event of a loss, this is the maximum that the insurance company will pay. Another important feature of motor insurance is the no claim bonus. If no claim for damage has been made under the policy for a year, the next year's policy, the own damage premium will have a discount for no claim bonus or no claim, since there was no claim made. Every year, continuous year, there is no claim for damage to the vehicle. The discount will increase starting from 20 for after 1 year, going up to a maximum of 50% of the own damage premium. A discount would be available. This no claim discount is available only to the owner of the vehicle. If the owner sells the vehicle and buys another vehicle, he can transfer it. But if there's a new vehicle, the new owner cannot claim that no claim bonus. He has to pay the premium for proportionately for the period when it is transferred in his or her name. In motor insurance, the types of claims are own damage. Claims are damage to the vehicle or theft of the vehicle. In the case of third party, the third party claims are injuries or death of people who have pedestrians on the road, or damage to property. Property includes animals. So if a vehicle kills cows or sheep or goat, there is a property damage and it will also be payable under the motor insurance. In motor insurance, the documents we will file, the most important, the proposal form, which we have seen in our lecture yesterday. A cover note may be issued. It's a temporary document given to take delivery of a new vehicle where engine number, chassis number and particulars of all the vehicle are not yet known. So temporary cover note is issued. It must be followed with a certificate of insurance. So all details must be conveyed to the insurance company and then a certificate will be issued. Cover note in motor insurance is valid for a minimum period of 15 days and can be extended by 15 days to a maximum of 60 days. After that, its validity is over and it must be transferred into a certificate. Then we have the policy, the document, contract terms. When a claim occurs, there will be a claim form to be filled. Driving license will have to be verified. The registration book, that the ownership, who is the owner, will have to be proved. Estimate of loss has to be given. Final bills after repairs. Police report may be asked for, so first information report. If it's a commercial vehicle, its permit and fitness are also required, because without that, under motor law, the registration is not valid. If it is a third-party claim, the court will send a notice and summons, and the insurance company has to deal with. So the court summons have to be forwarded to insurance company so that they can appoint a lawyer to defend on behalf of themselves and the insured. So this briefly was motor insurance. We will now go to the next, which is Public Liability Act. This is a compulsory insurance to be taken by anyone handling hazardous materials. When we say handling, it means storing, destroying, collecting, manufacturing, processing. So anyone dealing with hazardous materials must have this insurance. Under this insurance, if because of the handling of that material there is a pollution or there is an accident, then compensation has to be paid to the persons who are injured. For death and permanent total disablements, the compensation is 25,000 per person. In the case of permanent partial disablements, it will be a percentage of the permanent total as disablement as decided by the treating doctor. Temporary total disablement is available for persons over 16 years who are earning an income and who have been hospitalized for minimum 3 days and are unable to attend their work for a maximum of 3 months. So a monthly compensation of 1,000 rupees will be given to them for that period of disablement. So if they have been disabled for just 2 months, the compensation will be just 2,000 per month, 1,000 per month. That's 2,000. In addition, medical expenses of 12,500 will be available to anyone who has been injured or who has suffered consequences of a hazardous accident. Property damage, like motor insurance, is only for 6,000 rupees. Now the insurance is taken for a very limited sum, maximum amount of 5 crores per accident or incident and 15 crores in the year. There could be a time that the loss could be greater than that because many more people could have been injured, in which case, when taking the insurance, an additional amount is taken and transferred to the Government of India's Environment Relief Fund or ERF. This fund will pay out if the limit under the policy is exhausted. This fund will pay out for any additional compensation. Now an example I would give you, all of you are familiar with the gas leak at Bhopal. So had this insurance been in, this law come into force before Bhopal, each of the individuals, the families of those who died in that gas leak would have been entitled to 25,000 per person. Those who were injured would have got medical expenses of 12,500. If they are unable to attend duties, they would have got 1,000 per month for maximum 3 months. So in this manner, this is how the law applies because that was a hazardous accident. So if such accident takes place in the future, first this insurance will pay for those people. So it is compulsory for anyone handling hazardous material to have this insurance in place. If they do not have the insurance, the Pollution Control Board can imprison the person for a minimum of 1 year in addition to a fine of 1 lakh rupees. So this is required by law, just like motor third party insurance. Others and even those dealing in hazardous material can take, if you see the compensation was very low, they can take additional insurance to cover their liability. And these are known as standard general liability insurance. So one of the most important is public liability. We have seen Public Liability Act, which is a compulsory insurance. Now public liability, which is available for anybody. Even you and I could be held liable in the normal course of our lives. For example, if you are staying on a higher than first story in a premises and you have flower pots and plants on your balcony, and if due to a wind the pot on the balcony falls down and injures somebody passing by, you will be held liable to pay compensation for that to that injured party. So having public liability, if this policy will pay. The person who is injured has to prove that you were negligent, so they will file a case in a court of law, and the court of law will decide about the compensation to be paid. So this compensation can be any amount, and it is therefore necessary to have a public liability. So public liability is available for industrial risk, that is manufacturing risk, and also non-industrial risk like offices, shops, schools, colleges, residences, residentials, anyone can have the public liability policy. All these liability policies, compensation will be decided by a court of law. So a court case has to be filed, and the court has to be proved that it was accident and it is due to a negligent act. Then only compensation gets paid. In the case of product liability, it is the defect in the product that has caused an injury or a damage. It could happen that a product, many of you have come across cases like worms in the chocolates or in foodstuffs. Now, because you ate that chocolate and you developed food poisoning or some sickness developed, and you can prove that it was because of the chocolate, then you are entitled to file a case against the chocolate manufacturer and claim for compensation. So product liability is a branded product which is in the market, and as a result of which somebody has suffered by eating or using it. The most common product liability losses are taking place because of defective medicines or defective motor tires. So these are very common, but there are many other products that could cause losses or damages or sicknesses to people. So again, what we are seeing is somebody who is using the product, or an outsider, is affected because of the use of the product or being faced in a consequence, and as a result of which they are liable. They have suffered a loss, they have had financial loss, and they can file a suit and claim compensation. Professional indemnity. When we talk of professional indemnity, we talk of authorized professions, and those are lawyers, chartered accountants, engineers, and of course insurance brokers. So these are professionals, doctors and hospitals. So any negligence on their part, as a result, their clients suffer, they have to pay compensation. Many of you have read in the newspapers of an operation which has gone wrong, or after an operation something has been still left inside the person's body and the person has had major problems thereafter, and subsequently found out that sponge or cotton or some needle is inside the body of an earlier operation. So these are all cases of negligence, and invariably they go to court and claim compensation for injuries. In fact, you may be aware, those of you in Hyderabad, that the Hyderabad metro, at the time of being built, one part of the metro came crashing down while it was being constructed, so people were injured. So here also a type of liability came into being. Professionals are those who are guided by certain standards or controlled by certain standards of profession required from their profession, like the Medical Council, the Bar Council, the Institute of Engineers, and so we can define whether negligence has taken place or not and allow compensation accordingly. Directors and officers liability. As you know, if a director has not given proper guidance and as a result people have suffered consequences, they could be held liable for not working properly and to running of the company. Then workmen's compensation insurance. This is a compensation to work employees who are injured or suffer sickness while in the course of their duties. These briefly were the liability insurance policies. The features are, all of liability insurance policies will have a limit, two sums assured. One is called any one accident limit. So one incident, this value, and the other any 1 year limit. Within the year, this is the total payout an insurance company will pay. The premium rates are depending on the indemnity limit, that is also on the ratio of AOA to AOI. So AOA to AOI can be 1:1 to 1:6, 1:4. That is, say, any one accident 1 crore, any 1 year 1 crore, that's 1:1, or any one accident 1 crore, any 1 year 4 crores. So 1:4. So premium is charged on this plus on the turnover, because that is the exposure of the insurance policy to the number of people. it is all, the risks are classified unto various risks, and on that basis coverage is given. Within this limits, the defense costs and legal charges are also payable. Liability insurance are normally claims-made policies. That means insurance must be running concurrently and continuously to claim under the policy, because when the loss is reported and the claim actually comes in, there could be many years in between. Occurrence-based policies are on the date of loss, on the date of the accident, there was an insurance, but insurance is not continued. So motor third party is an occurrence-based policy. Employees' compensation, that is what we old workmen's compensation, is also an occurrence-based policy. Accident insurance. The next product policy is personal accident insurance. It is a benefit policy, which means we are not looking at income clearly. We are just seeing the approximate income to arrive at a sum assured, which can be changed every year. We play for compensate the individual for an accident which will result in their death or in permanent total disablements or in permanent partial disablements. So permanent total disablement means now totally confined to bed and unable to do anything. Permanent partial disablements mean some part of the body is lost. It could be a hand, a finger, 2 fingers, 3 fingers. This is known as permanent partial disablement. Or temporary total disablement, that is for some period of time unable to attend to any duties and confined to home. For example, a fracture to the leg, the person has to sit at home for 6 weeks, so temporary total disablement. In the event of death of the individual, if the individual has minor children, an education fund of 5,000 rupees is also payable per child, maximum for 2 children. So in the event of an accidental death, besides the education fund, the expenses towards carriage of the body to the final rites or to the home, but up to a fixed amount is also allowed. Medical expenses can also be taken as an add-on, and war risk cover can also be taken. Something got left. There's one more, I think. Health insurance miss ho gaya. Another policy that we have to look at, and that is health insurance, where we are paying for reimbursement of medical expenses if a person has to be hospitalized due to a sickness or a disease or an accident. Now this is hospitalization only, reimbursement expenses are to be paid. So the person has to be hospitalized. They must not have an existing health, sickness at the time of taking insurance, because pre-existings are not covered, and so also anything that occurs in the first 2 years with regard to cataract, sinus, etc. Maternity expenses are also not covered unless the add-on is taken, which is available for group insurance. So this briefly was our chapters on fire insurance, marine, and some important motor, accident and liability insurances. This ends our session for today, but before we end up, we'll just look at a few questions that have been raised with regard to yesterday's session, or the session that was held earlier. Anil Mohalkar has asked, what is to pool? A pool means a creation of a fund to pay out for any losses. So in India today, we have, one is a marine hull pool which GIC manages, and the other is the terrorism pool. What it means that every insurance company is contributing some money every year from their premium into this pool to create capacity to pay out in the event of major losses. So we are trying to increase our capacity within the country, first to ensure losses can be covered, and if it exceeds these amounts, we then look at reinsurance, which we will be saying subsequently in our future classes. We have already talked about marine open policy and open cover. As I explained, open policy means a policy is issued for a sum assured and all declarations are made up to a number of cargo going to different places. So each cargo, instead of taking separate insurance for each, we take a open policy and we keep declaring the cargo for each location or wherever we wish to send it. Each consignment is declared and deducted from the sum insured that we have originally taken. So the open policy remains in force till the sum insured is exhausted or it is reinstated to cover future losses too. So each time the sum insured is being reduced by the amount declared. In an open cover, it is an agreement and a deposit is kept. Each and every time a consignment is to be sent, we inform the insurance company. They issue a document, an official document, a policy for that particular consignment, but it is under open cover. So what they do is, an open cover ensures that all consignments can be covered since instead of declarations can be made at a later date rather than rushing in advance to take the policy each time a cargo has to be sent. So specific policy is a single cargo insurance. An open policy, because I am dealing with so many consignments, I take an open policy and keep declaring to the insurance company that please insure this, but I have kept a limit or a sum insured with them to pay for the premium, so that no cargo gets missed without insurance. So ICCA, Rameshwar Gaur, ICCA Institute Cargo Clause A, which is an all-risk cover for export-import trade. These policy wordings are used to cover consignments being exported or imported. The wordings are decided by London underwriters and it is standardized across the world. What is hit and run? Yes, sorry, I forgot to mention. In motor third-party insurance, you have to prove that the insurance was in force, then only the person who is injured can claim. Now, if they're injured in an accident and the vehicle number was not known and noted and the person is injured, against whom can he claim? He has no one. In fact, just 2 days ago, after I finished this lecture, I was going home and an accident took place just outside on the main road. A man was getting off the bus and a two-wheeler knocked him down. He rolled over and another two-wheeler also fell. He was so badly injured, we had to call for an ambulance and take him and the police, and he was taken to a hospital. His back was badly injured. Now, unfortunately, there were so many of us waiting, but because the poor lighting, none of us could note down the number of the two-wheeler. So this is a case of hit and run. Because number is not noted, we could not find. Now the gentleman who is injured can file a case under the hit and run, which will be paid out of a fund called the Solatium Fund, a special fund created to pay for such accident victims who cannot identify the vehicle for claiming against the owner, and so a small amount of compensation is given to them. But he has to file a case under the hit and run clause. So this in brief was some questions which we dealt with on our chapter 1 and 2. I believe there are a number of questions for this chapters 3 and 4 already come in, but as our time is running out, we will end up for today. Tomorrow when we meet, I will look at and answer some of the questions that you have given within the time constraints that we have. So to sum up, we have looked at fire insurance, what can be covered under fire policy. We have looked at marine insurance, which includes cargo insurance primarily, since most of you will deal with cargo insurance. Hull insurance, the insurance of ships, is restricted or covered in only the main port cities. That's Kolkata, Chennai and Mumbai are the places where we will be dealing in that. And that also you will come across very few offices or people. So we will, when you do your associate level, you will be having a chance to look at that in more detail and understand it better. Now it is just to give you a picture Licentiate is essentially to give you a picture of the various types of products available in the market and the concept and how insurance has to be practiced. We have seen motor insurance, which again is a common insurance, which all of you would come across in your day-to-day work. We have also seen personal accident and general public liabilities, which is again a common thing now today with everyone taking these insurances. An idea has been given to you. When you appear for your associates, then we will look at it in very much more detail and we will have lots of questions and lots of interactions for you. So with that, I close my session for today. I will meet you all again tomorrow when we look at the next two chapters. Thank you.